can you really retire earlier than planned and spend more in retirement without running out of money? The answer is yes, but you've got to follow 3 steps. This is going to be easy to understand, even if you don't love the financial planning strategies and tactics and things like that. It's all based on historical data in real scenarios that I'm going to share with you. So in this video, I'll share what are the simple steps, and then how anyone can implement this, and then also give examples with real numbers and case studies. So let me put some dollars behind this just to give you an idea of what we're going to be talking about. Now, remember the dollars here that I mentioned, that's not the important part. Whether we're talking about $100,000 or $100 million, I'm just going to use a number, and it's all for just the concept that we're going over. So I'm just going to use $40,000 is what this person in this first scenario wants to take out of their accounts and use in retirement. Like many people, they'll look at the 4% rule, which means they have to save $1 million to take out $40,000 a year. But with this system, these 3 steps that we'll go over, they'd actually only need to save a little over $700,000 to get and meet that $40,000 need, which would come closer to the 5.5% withdrawal rate. That's interesting. This also means that if they had already saved $1 million, that could produce $55,000 worth of income versus the $40,000. But to achieve this higher withdrawal rate and not worry about running out of money, we need to apply the 3-step filter or system, and it just needs to be applied once per year at the end of the year. So this cheat code could allow that person in this fake scenario to retire with almost $300,000 less than what they thought they could originally. That's exciting stuff. Very quickly, before we get into it, I'm Dave Zoller, and I own Streamline Financial with Tim and Luke and Sean. And it's a retirement planning firm that's been around for 25 years, and we help a select number of clients. But we created this channel to share the strategies and even the mindsets that we use for our high net worth clients, and then share them here so that hopefully everyone can benefit from it. So now, how do we do this with the 3 steps and this withdrawal strategy? I'll start with the basic rule that everybody's heard of before, and I already mentioned it, and that's the 4% rule. But if we want to spend more than 4% per year and not run out of money, then we've got a few extra steps. Step 1 is we need to remember and just know that our expenses are not all the same. To keep it big picture, we've got 2 types of expenses in retirement. We've got our fixed expenses, or this could be needs, things like housing cost or food cost or utilities or medical expenses. These are the things that we need to have to live. It's the essentials. And then there are the nice to haves, or we can call this one the wants. And this is like vacations or entertainment, going to venues or, and sorry for all you golfers, this could even mean the golf memberships. I hope I didn't lose you here, but you get what I mean. And whether or not you use a strategy like the one we're talking about in this video, it's a good idea to get a ballpark estimate of your needs and your wants in retirement. Because whether you have 20 minutes or 2 hours to figure this out, it's going to be worth it. The payoff is really increased peace of mind in retirement. Because right now, take Bill, we call him Bill. He's in the Chicago suburbs, and he adds up all of his expenses, and he sees that he needs about $80K to live on. But in reality, the absolute essentials, the needs, might only be $40,000. And he doesn't have to change anything in his income plan, but just knowing that he could reduce his expenses needed in retirement and still be okay, that's a load off his shoulders, right? It's kind of like a plan B if he needed it. And that could give him the confidence to say goodbye to the work paycheck. So we understand the 2 types of expenses. Now what's next? Step 2 is we need to get to the end of the year, and then we have to identify which type of 3 markets did we just experience. Was it a normal market? I'll go over the 3 right now. Normal market, which would be the S&P 500's not down more than 10%. So anything above negative 10% from its highs. Or was it a correction where it's down between negative 10 to negative 20% from the highs? Or is it a bear market? Did we just experience a bear market where it's negative 20% or more down from the highs? So based on these 3, whatever we went through, that determines how much of the discretionary or the want expenses we should spend the following year. Now, what's the actual example of putting this in action? And this is step 3, implementing this. So let's pretend you've got $1 million and you want to take out $55,000 per year. And we figure out that half of 55,000 is the needs and then half is the wants. So to round it out, I'll just say it's, if we're doing this, we're just going to say it's 27K and 27. And two, if you're thinking that 50% discretionary spending is too high or low, I'll give you a chart that comes up with all the different scenarios here so you can find what is reasonable for you coming up. And also, I'm just going to leave out Social Security just for the simplicity, sake of simplicity when going over this. So what would this mean? If this was the scenario where we want to spend, got $1 million, spend, I'm rounding down, a little less than 5.5%. So needs and wants, what does that look like in a normal market? Well, according to the research, it's in a normal market, you could spend all, of course, your needs, which you have to spend, and all of the wants. Then if we're going through a correction between 10 and 20% off the highs, the change in spending is spend half of the wants in this scenario. Spend all the needs, half of the wants. And then in a bad or bear market, more than 20% down, then we would say don't spend any of the wants the next year. So what is different about this plan is that there's some flexibility built in to this withdrawal strategy. And the thing that this is doing, I'll go over some of the reasons why this could work. One of the things it's doing is protecting from sequence of returns risk. Now, just one thing on this too, the full disclosure, this is not how our clients' spending plans work. Theirs are a lot more dynamic and they factor in tax planning and withdrawal strategy and even estate planning. But I wanted to get this to you because it's interesting and it's different from the way that you hear or think about spending plans, right? Sometimes we hear, what's the right withdrawal rate? And just do that forever, or, just spend the dividends and the interest. You hear all these different things. This is one I thought you might find useful to put in your tool belt, or at least evaluate your own plan through. And as with anything, since we're not working together, this isn't financial advice. This is really some ideas, some things to get the wheels spinning. Be sure to talk to your financial professionals before doing anything like this. But as you're evaluating these different ideas, here are some of the reasons why something like this could work. One, it helps you spend more than 4% per year. And two, it helps you protect from sequence of returns risk, like I just said, which is really one of the biggest risks we face in retirement because it leads to people running out of money. And I want to share an example of this and give you some numbers and see how much of an impact sequence of returns risk can have on retirement. And then I'll get to the chart that shows the needs and wants, how much is what percentage of your spending, so you could see how it applies to you. So here's the scenario for sequence of returns risk. And maybe I'll write something down here to help illustrate it. But let's pretend you had $1 million at the beginning of the year. We'll write it down. So maybe this will be helpful, but here's the entire year. And you had 1 million at the beginning of the year. And the plan is to retire this year and then start withdrawals the next year, January 1. Again, I'm keeping things simple here just for the illustration. But over this year, 1 million, it's a down market and it drops by 10%. And now the value is $900,000. And then it's the next year. So we take out 40K because you were relying on this initial planning arrangement that you came up with. So that would leave you with, the beginning of the year, $860,000. Now, good news, the following year, you make the withdrawal, and the following year, things go back up and it goes up 11.11%. And the reason why I chose that is to get back to the 0% return of the account value. So over the course of this entire year, the return has been 0, but then what's the value of your account? With a net return of 0, it'd be nice if the account value equaled $960,000, right? Because you took out $40,000, but it's really equal to $955,000. So what happened to that $5,000? Well, it's gone because that 40K withdrawal was never part of the recovery. If there's a point where there's a string of these bad timing withdrawals, that could hurt the portfolio over the long term. And having some flexibility in your spending plan is a good idea. Now, if you want to look at needs and wants, and expense numbers are not going to be 50% needs and 50% wants, here's a chart to pause. I'll put it up here. You can pause it and take a snapshot. And this data comes from the Mad Scientist research, an article here, which is worth reading. And it's a really good article kind of detailing everything we're talking about. But here's the data. So as an example, let's pretend discretionary expenses here are actually 60%. So 40% needs, 60% wants. Well, according to history, it could even be reasonable to have a 6% withdrawal rate in that case. What if it's only, most of your spending is needs and you only have 30% that are wants or discretionary spending? Then we may want to have a withdrawal rate that's a little bit lower, but in this case, still better than the 4% rule. So I'll include the link to this to do more research and look, but hopefully it made you think a little bit differently about spending. The important thing here is that the withdrawal strategy is very important in your retirement planning. At Streamline, we actually believe that it's even more important than the investment allocations and the investment mix. They're both important, but we see a lot of the value come when thinking about strategic withdrawal strategy and then combine that with tax planning. And it's really could be quite magical. That's a nerd thinking it's magical. But anyways, if you kind of understand that, then check out this video on the common mistakes that we see when implementing withdrawal strategies. And then this one on a similarity we've seen smart retirees, how they plan for retirement. So I'll see you in those videos and take care.